Hello, good afternoon. I'm Henriette Dybkjær from MDC. Welcome to this second day of MDC Tidbits. I'm sure some of you might not be aware what a tidbit is. So I would like to explain it for you who do not know, because I didn't know when I got this proposal from my colleague that we should call it tidbits. A tidbit is a small piece of interesting information, actually what you will win your Trivial Pursuit with, knowing these small tidbits. And a tidbit is also a very delicious piece of food, a good tasty piece. So this is why we thought that it was a good name for this knowledge that you'll get accompanied by your lunch with your fellow maritime colleagues. So what kind of tidbits will we serve for you? We have identified 3 interesting pieces. First piece is stories. Second piece is tips and trends. And third piece is trend and analysis. These pieces will be served for you by our different chefs every day. No, not every day. We hope that we will come to every day, but by now it will be Tuesday, Wednesday, and Thursday at 12 o'clock. It will last for around 15 minutes, the presentation, and 15 minutes of Q&A afterwards. So we will be done by 12:30. You're of course welcome to log out anytime you need to do something different. So let's get started. I don't know if you have prepared, but I have prepared my lunch. And let's have a toast for a good tidbit today. And this is my first tidbit, as I told you, so I hope that the technical side of this crowdcast webinar will not be too challenging. So I will be happy to invite my chef of today, who is the chief analyst of BIMCO, Mr. Peter Sand. He will be taking you through the shipping market, and who don't want to know a bit about that? Tank rates goes up, container shipping is challenged. I'm looking so much forward to hear what Peter has to tell us. And he will serve you some bite-sized pieces of the insights from BIMCO's market analysis of shipping. So, Peter, are you ready? I'll put you up on the full screen now.
I am absolutely delighted to be joining these MDC tidbits, or dish of the day, serving today from the House of BIMCO. Henriette, thanks to you and your team, and thank you all for joining in. I can only bid you all a good lunch, and without further ado, please bring up my slide deck. So I will take you through a whirlwind of how we see the markets developing right now.
That was the wrong one.
It's good to see so many of you joining in here. Hopefully on your screen right now you have the bite-sized pieces and the front cover of my slide deck, and this is today's menu. I will start by serving trade volumes with the side of PMI. Then we move on to the house specialty, which is the focus on the main shipping markets. And then, of course, you should be spoiled towards the end with a little bit of, well, what actually started as the big thing this year, but has turned out to be, can anyone recall what is really going on in the IMO 2020 sulfur cap? Well, in all fairness, I'll bring you up to speed on that as we move towards the end. For those of you who are not completely familiar with the BIMCO is the world's largest shipping association, and we serve a global membership of large ship owners and small port agents and everyone in between. So get in touch in case you need that supportive organization by your side through this massive crisis. I can only bring you forward also this piece of literature. It's called Ship Layout Guide, something we did together with Witherbiz. It's not a dish you would like on your coffee table serving anyone, but in all fairness, this is also a part of the help and assistance that we can offer to anyone out there, and those who are seeking more knowledge in terms of what are my options in a challenging environment like the one we are in right now. So we left 2019 looking at 2020 with, well, mixed feelings to be absolutely sure. Just to bring everyone up to speed on how we saw 2020 only a few months ago. If we go by dry bulk, we expected dry bulk to move into a somewhat more difficult year in 2020 as opposed to 2019. For tankers, we expected somewhat of tailwind to continue throughout the first quarter due to seasonality, and then receive more headwinds due to overcapacity. And for container shipping, it was more, say, of a repeat of what we already had come through in 2019. But leaving all that aside, the one thing that has ruined every forecast, every estimate, or every projection for anyone across the globe is, of course, this corona pandemic. For starters, please look at the left-hand side here, where WTO, the World Trade Organization, have put together two scenarios. One they call the optimistic one where world trade drops by 13% to rebound somewhat in 2021, growing 21% in 2021. And then they have a pessimistic scenario of 32% drop in 2020. Which one it's going to be? Anywhere in between, I guess, is the guess right now. It's highly likely that we're going to see at least 13% of fall in merchandise trade. But now, put your attention to the slide on the right-hand side, because it can sometimes deceive to look at growth rates only on a year-to-year basis. So when you look at the numbers on growth in 2021, and you see, wow, we're up 21% or 24% in 2021. Is that good or bad? Well, it all depends on your base year. So that's why we based it all on the right-hand side. So you can see that it's more or less the similar recovery that we're looking for in 2021. But the basis, of course, is very, very different. If you start in 68, it's very different from 78. Okay, so be very much aware that we're staring down the abyss, and it's going to be a tall challenge climbing back. BIMCO expects not any V-shaped recovery or any other letter in that game. We expect only a slow and gradual return to what we can somewhat call a new normal. A different way to look at it, if you glance the manufacturing PMIs, and these are the most recent ones. Tomorrow, or literally at midnight, we're going to have the latest numbers coming out of China. But before then, let's take a look at how the coronavirus have impacted the shipping industry already indirectly by the meltdown, or at least the lockdown in manufacturing sectors. We saw China being first hit, and we also saw the manufacturing PMIs from China drop already in February. We see now PMIs in Europe and US following that same trend going down. But the big question, of course, how should I read this? I told you just before to forget about a V-shaped recovery. And please be very much aware that the V that you can see now for Chinese getting back to a 52 level is not a full recovery. It only sets out a stabilization from the month earlier. The way to read a PMI is changes in activity from the month before that. So when we have a reading of approximately 35 in February in China, and we have 52 in March, that means that we're only slightly ahead of the lows of February when we now look at the numbers in March. In order to get back to what was sometimes a little bit of normal levels, we need multiple months much more than 52 levels. So what we're looking forward in terms of numbers from China tonight is an indication of a much stronger manufacturing sector. So we could look at 60, hopefully a number which is even higher than that, because again we have the basis of February and March going forward. So that is surely an indication that we're watching very closely out for. Those of you who are not regulars on shipping freight rates, I'm sure it has caught everyone's headline. Even the Financial Times this morning is covering floating storage to the extent possible, because it's fair to say that there are so much going on in the oil market, and there is so much going on in the oil tanker market right now, and it's all over the place. Data is crunched to an extent perhaps not seen before, and I think it's also fair to say that some of those data perhaps find itself a bit more naked in the spotlight of today than would otherwise be appropriate. Numbers that I'm particularly highlighting here is, for instance, the focus on storage on land as well as storage floating. No one have a full overview which is claimed to be the whole truth and nothing but the truth. Without doubt, this is not only a moving target, but it's also an uncertain science. So how do we measure floating storage? Is that when a ship is just carrying a cargo? It could be. Or is it when a ship is anchored up in the same position for more than a month? That could also count as floating storage. So be very much aware when you read into these numbers. But let's take a look at what really happened and what kicked this crazy market off. We have indicated here the oil price war starting early March and the OPEC Plus deal in April. Both hugely impacting the oil tanker shipping market. Firstly, with the drop of the oil price by Saudi Arabia when the alliance broke down, we subsequently had Saudi Arabia pumping plus 12 million barrels a day, and they needed tankers to export that, and we will see that on the next hand slide how that basically put the markets on fire. But sticking to this small bite-sized piece and the right-hand side here, where we have the crude oil stocks and the development of the VTI price in the US, the benchmark for oil pricing in the US. We see that infamous drop to minus 37 when a day before the May delivery contract future expired. That is still scrutinized, I guess, also by authorities, but it points to a fact that too much oil is produced when compared to the underlying demand. Please be aware also that Cushing, Oklahoma may be the delivery point of all the world, at least it seems from an anecdotal basis. But in all fairness, if you look at the data, at least those we tend to rely on in a crisis like today, and basically generally proves that the stocks available in Cushing, Oklahoma accounts to approximately 3% of total US stocks. So please do not make the mistake of using Cushing, Oklahoma stock building as a proxy for what goes on in US as such, as well as the whole world. But talking about how did this impact the tanker freight rates? Well, you may recall also the great month of September and October last year when sanctions set the markets on fire. Now we got a new situation, and we got the Saudis back in the market in March for a significant amount of tankers in a very short period of time, lifting rates above $200,000 a day. They currently sit also, as we speak, somewhere in the range of $160,000, $180,000 a day. We see most recently also oil product tanker earnings going to very high levels. Have they peaked? Well, I can't give you the 100% clear reply to that, but they are surely also impacted by the extent that that floating storage is a part of the business today. But for how long will this last? I know it goes against the grain, or at least against many pundits, when we advocate, or at least, well, this is not about being advocates. It's about reading the data you have in front of you in a different way. And when the Saudis are now looking into limiting their production, and we see also the wider OPEC Plus limiting their production very shortly, coming into May, we see a reversal of fortunes. So fingers crossed, we will see elevated tanker earnings for still some time, but our baseline is that come the month of May, we will see weaker earnings as the month progresses. If we look at well, at least some kind of estimates on demand as well as a supply of oil, we see a fairly large contraction of oil demand in Q1 already registered, and also for Q2 very likely to happen. It's fair to say also that the newer the estimate for global oil demand in 2020 years, the deeper the abyss seems to be. We have, of course, OPEC being out with their estimates of 6.9 million barrels of a drop in demand in 2020 as compared to the year before. We have also the International Energy Agency and the U.S. Energy Department being out with estimates around 5-6 million barrels a day on average lost in 2020. What will be the final number? Only time can tell. But this is basically what you're looking into when you're debating production that exceeds demand, and of course the resulting fall in prices. If we move into container shipping, absolutely a knife's edge market that is currently holding up quite well if we look only at the freight rates, and we will do so quite shortly. But let me just give you a tiny brief in terms of, well, we know that global container exports are slowing across the board. I've just highlighted for you for lunch today the numbers that we see in terms of loaded containers in and out of U.S. West Coast. As you can see, in particular, the imports are down by some 13% if you look at the first quarter numbers of 2020, comparing that to the first quarter of last year. You see a significant contraction in imports from everywhere. You see the full numbers also in terms of exports. They are not impacted to the same extent, but still they sit in negative territory. And what is it that we are likely to not see at the quays in U.S. East Coast going forward? Well, that's what the American consumers are not buying at the moment. And what is it that they're not buying? Well, look at these staggering numbers. They are not buying clothes. They are basically buying only half what they did in February. If you look at the month of March, these are the flash estimates coming from US on retail sales, and I've highlighted the number one here: clothing and clothing accessories. Of course, if you are in a lockdown, you cannot go to your store and buy clothes. But having numbers down by 50% from February to March, it's staggering. If we move up to the number 2 arrow, I have furniture and home furniture also in stores, and motor vehicle and part dealers down by a quarter from February into March. These are all key containerized goods. So when we see no more buying of those goods in US, it is likely naturally also to impact the demand from shippers bringing goods into the US, further impacting with a somewhat of a delay. If we look forward, how are we going to see imports of loaded containers into US West Coast, but US in general? It's likely to be severe and is likely to go one way only, and that's down. As alluded to just before, container freight rates have held up fairly well so far, but it is done in a, well, we call it an artificially way. And why do we do that? Well, we do that because of 10% idle fleet capacity recorded right now. We did see early April numbers hit 2.5 million TEUs. Currently, that number is around 2.2 million. The month of May could turn out to be a pretty ugly month also in terms of idling ship capacity in the container business. But this illustration basically tells you that idling of ships is across the board. Of course, blank sailings also on some of the main trades are record high right now. You only need to open a simple browser to see the headlines on massive wide-scale blank sailings. Okay, so is China capable of bringing the dry bulk market out of the doldrums all by itself? The short answer is unlikely, because there is a knock-on effect from the lockdown in China, bringing us back to the PMIs that we opened for starters. But now that we are in the final part of the main course, let me just open that up to you and give you the most recent freight rates also, where you can see somewhat of weakness on the Cape sizes following somewhat of a nice increase in rates that just touched on 10,000 and now sit around $8,000 a day. This goes a little bit against what we have seen out of Brazil in terms of iron ore exports in recent weeks, where the number of spot cargoes offered to the independent owners have picked up nicely in the past couple of weeks, but apparently it doesn't seem to result in higher earnings. But look at the numbers that I show you here. I mean, on the right-hand side, you have Australian exports being significantly down, but still, you need to compare that to a normal year, if you can have something like that for Brazilian exports. I'm sure every one of you know about the difficulties they faced in Brazil last spring with the collapsing tailings dam and the subsequent problems they had in bringing iron ore exports up again, and iron ore exports to the white market. But if you look at the left-hand side, just before we move on, you see that China was actually capable of bringing in a lot of goods in the first quarter of this year. But basically, all deals were done prior to the outbreak of the coronavirus. So if there's any lesson to be learned here, I think it's fair to say that we are seeing indications already now in freight rates of a weakness from Chinese buyers of commodities. One that could result in a across the board slowing of imports of dry bulk commodities on a global scale, including potentially also grains, which is currently the one that seems to be surprising on the upside, or at least being stable, as we all need to eat, and we all need to feed our livestock. So that could be one of the reasons for that to keep up. One of the things that have kept up also during these early months of the coronavirus crisis is South American grain exports. As you know, we have covered also in great depth the trade war with the US and China, and in between you have Brazilian soybeans, where you can see that not record high, but quite staggering reversal of fortune from a quite devastating numbers in January and February out of Brazil, but 11.3 million exported in the month of March. And in a supporting role, you have Argentina also bringing out 5 million tons to the market in March. We note that wheat numbers are somewhat down from particularly from January, but also from February. But it surely assisted somewhat the Supramax and Panamax freight rates throughout the month of March. So, wrapping it all up with the complimentary of the chef, the IMO 2020 sulfur cap. As I said, we almost forgot about it, but well, and then we did not. It was only just put a little bit into the shadows by something which was just so intense and so massive, of course, the coronavirus outbreak. But look at the staggering numbers here in terms of the proxy that we have put together with a composite of average prices in Singapore, Rotterdam, and Fujairah to give you like a broad spectrum of what goes on a global scale. And the way to read this is, of course, you can see the narrowing on the spread. You can see the heavy sulfur fuel oil being quoted at around $140 a metric ton. And then you see the two, you see the magenta colored line and you see the light blue line, which is very low sulfur fuel oil and marine gas oil. Opening up somewhat of a nice discount, one that was also almost not there in the early parts of the month of January. I think on 8th January, the very low sulfur fuel oil was even priced with a premium to marine gas oil, and that just illustrates how uncertain and how much nervousness the market experienced at that point in time. But you can certainly see also the effect, of course, of the oil price war in the subsequent products all coming from the same feedstock of crude oil, bringing bunkers down massively. On the right-hand side, you have Singapore bunker sales, and very interesting indication of the market, which is still left for heavy sulfur fuel oil, which is still the dark blue part of this, somewhat leaving the lows of February, going into some 15% in March. And naturally, with a bunch of scrubbers still being installed on board ships, you will have a market for heavy sulfur fuel oil in Singapore on a global scale, even though we have seen the wider shipping industry preferring to go without a scrubber. And as you can see also, the majority of sales here, we have 82% of low sulfur fuels as a share of the total sales. So this is certainly one of the indicators that we also look very much into. But it remains, of course, a fact that as long as there is a premium to low sulfur fuels on top of heavy sulfur fuels, it does to some extent make sense to have a scrubber on board. So this is not a reversal of fortune for those who invested in a scrubber. Naturally, if you put it into your spreadsheet, it does take a few more months to bring back your investments. But surely, I mean, this was an unforeseeable event in many ways. Naturally, some of it can be explained by the normal relation between the prices, but the development from $700 down to $200, that is of course exacerbated by the oil price war and the subsequent OPEC Plus deal. So when lunch is all digested today, where should you go? Well, check out the BIMCO.org website /COVID-19, because we have, as an extraordinary times require extraordinary measures. We have, of course, also taken steps at BIMCO to serve not only our members at our best abilities, but certainly the wider shipping industry. So we have opened up parts of our website that relates to information on COVID-19. So I can only encourage you to click on that link and stop by for COVID-19 insights. Should you like more information also on market analysis, that is readily available for everyone on the BIMCO website. For members only, we also have a section with market reports and the multimedia. Well, you can check out our stuff on the website for members only, but you can also check out any of these channels, the BIMCO YouTube channel, naturally featuring many of those videos that you just saw in terms of multimedia content on the previous slide. But follow us, subscribe, check out how we see the market developing for the main shipping sectors and the wider shipping industry as such on Twitter, on LinkedIn, YouTube, and even Facebook. Thank you so much for your kind attention. I hope you have enjoyed this meal. Hopefully you have also questions about how, that relates more specifically to your line of business, and I shall be extremely happy to give my view on that and explain to you how BIMCO sees the development for that particular sector. So thank you so much for your kind attention.
Peter, thank you so much for your input. I can tell everybody that we have broadcasted now for 30 minutes and 40 seconds. So if any of you need to run away to other things on online meetings, please do feel free to leave the webinar. But Peter, can we go on for another 10 minutes approximately? I can see there is a few questions here. Is that okay with you?
Absolutely. I know that I may be the only one not having lunch yet, but not to worry. I know I have spent time well so far, but please let's of course dig into the bonus dessert.
Well, the first question is more or less the same that I had prepared for you, which is which segment of shipping, dry bulk, tankers, or containers, do you think is expected to recover faster after the COVID situation?
I think it's important to be aware that there are no quick fixes to the COVID-19 situation. It is still very much a moving target and a monster that we haven't seen the full extent of. And when we look at three major shipping sectors, that is all likely to see demand contracting this year. When we move into the next year, that overcapacity that we already brought into 2020 is getting bigger. So quite a few challenges are in the pipeline also once the dust settles on COVID-19. But should we pick a sector that may be somewhat more clearly with light at the end of the tunnel, I expect that could be in the region of dry bulk, and why would that be? That would be due to the normal knee-jerk effect from China, where they put a massive stimulus into the market on the back of a crisis. We expect them to bring, say, stimuli that will support the shipping market, not upfront, but a bit later. We expect the first wave of Chinese stimuli to deliver more focus on domestic demand and domestic employment, but a little bit further down the road, naturally, some of that will also have positive knock-on effects on dry bulk shipping. But it is a very, very cloudy crystal ball that we're looking into right now. But I think it's fair to say that China may be where we should look for the first lights of sunshine once we get a more clear view on that development.
So I'm going to hold my horses because I was sure that I would be able to consider whether to buy Maersk, Torm, or Norden by the end of today. But I keep my savings on the bank account further on. Good.
Please be aware that our views on the market comes with a full disclaimer. You should know that anything that I have said here today was prepared at all our best abilities, but we take no liabilities. Believe at your own risk. It could also be damn lies what I'm telling you here today. I can only repeat a full disclaimer, especially during these times.
Of course, I still think shipping is a better investment right now than airplanes and airports. So has been tough times for them in these days. Well, we have another question, which is what what's your outlook for the seaborne thermal and cooking coal markets?
We see right now in terms of coal, special thermal coal for power generation being somewhat under pressure. Our numbers that we look at from the world's largest consumer of thermal coal, China, we have burn rates that are still not up to where they were a year ago. We have followed those quite clearly in cooperation with our good partner in Commodore, who's following the burn rate of major power plants on the Chinese east coast, and they are sitting still somewhat in the range of 5 to 10% below last year. So as you may recall, China had a massive import growth of thermal coal, in particular in the first quarter. But going forward, we're likely to see somewhat of a souring of that, and it goes, of course, also for the steel producing ingredient of coking coal. Not only the long hauls in particular, so we're not likely to see a significant support of, for instance, U.S. exports in terms of coking coal going into the Far East. This is likely a situation that will keep a higher focus on the shorter hauls, and as you may be aware that all coal trades are amongst the shorter hauls in the whole region of dry bulk shipping. If we go by thermal coal, for instance, that's very much an Indonesian business, and from Indonesia to China, it's not a lot of nautical miles.
Cool. There are no more questions posed. If you have any further questions to Peter, you can find him at the LinkedIn, where you can also follow many of his very interesting posts where he shares his small tidbits of knowledge, which his followers at LinkedIn. So please do follow Peter. I will also tell you that this broadcast has this webinar had been broadcasted. So with the link where you have that you have checked in with, you can find the broadcast as soon as we close it down. I'm going to say thank you so much to you, Peter, for your insights and for a
Thanks for having me.
I really enjoyed. And
Me too.
I hope that we will see you for some of the other tidbits we have for other sectors. Like, for example, tomorrow we'll have a tidbit where Inger Klein-Torhauge, who is the captain of a huge cruise cruise ship, the Queen Elizabeth, which is right now situated together with other 10 cruise ships just 6 sea miles out of Manila. And we will not be able to have her on a video call, so she will be on a phone call tomorrow, telling her story about how to be a captain on a cruise ship. That will be tomorrow's tidbit. So as you are more specialized into other segments, that might be of a good tidbit for you, Peter, to join in tomorrow at 12 o'clock. So if you want to follow our tidbits, I'm just putting up here a website, mbc.center.newsletter. That's not a newsletter, it's invitations and an event calendar you'll get there. And there you'll get the invitations for other tidbits that we are doing. The new tidbits for next week will be out on Friday. So watch out at our LinkedIn, and if you sign up for the invitations for the tidbits of next week. And do feel free to contact me if you have some good ideas to tidbits that we can provide to our maritime colleagues. So thank you so much for a wonderful menu today, Peter, and thank you to all of you for spending your lunch. Sorry for a little delay. It was a little bit longer than expected, but I hope you can extend your working day a little bit further on this afternoon to catch up with what you didn't get done of your emails right now. So have a wonderful day, everyone, and bon appetit, Peter. Thank you.
Thank you so much for your kind attention. Take care. Stay in touch.